You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
No discussions in the podcast are meant as an offer to sell or a solicitation for an offer to buy any security. All investments should be done after careful review and consideration of the investment documents and disclosures. Contents discussed in the podcast are not meant to be construed as an investment, tax, or legal advice. Individuals should always consult his or her own professional advisors before any investment decision.
Hey everybody, welcome to another episode of Alternative Investor Mastermind. Really excited for today's episode. I've been following this guy for a while. It puts a ton of great content out there. Aleksey Chernobelskiy. Aleksey, thank you for joining the show.
Hey, thanks again for having me.
Great. So, I've been following you for a while, but just for our audience, please just give us a little bit, just kind of tell us your story, your background, and how you, got involved in the investing space.
For sure. So did investments out of undergrad, all kinds. Ultimately went to work for a public real estate investment trust where I led the underwriting team in a $10 billion portfolio of real estate in the U.S. And after that, I ultimately went on my own and decided to start the venture that I'm currently doing, which is to advise LPs. So currently full-time, that's what I'm doing, advising LPs on both existing transactions and new ones.
Cool. And, coming from that institutional public REIT background, like what have you taken from your past experience and how has that informed how you look at, maybe more or less institutional LP deals, which, is where I think both of us have a decent amount of focus.
Right. It's actually interesting because even though the REIT was institutional, obviously, like we raised the money on the public markets, and as a big company, you have much easier access to capital and much more efficient access to capital. The type of buildings that we bought were very sub-institutional. In other words, we bought buildings tied to lower middle market businesses. And so I'm actually pretty familiar with, let's call it the challenges of running a small to mid-market business, because I would get balance sheets that don't balance sometimes. But the business does 10 million in EBITDA, let's say. And it's the gut reaction is what are you doing? How can you run a business like that? But the reality is people do, and it actually is a $10 million business. And people just don't have everything in order at all times, right? And that's okay. So that sort of shed a lot of light as to how I think about GPs. I mean, a GP entity by nature, I think, is a startup, right? And it's run on fees and hopefully at some point to promote. And until some level of stabilization, it's a pretty risky endeavor, which means certain things for LPs, it means certain things for GPs, right? And it's an important way to align interests between the two parties.
Yeah, absolutely. And I remember when I first got out of college in my first job or two, I was shocked at how disorganized. I always thought business would be a little more proper and efficient and organized. And I learned pretty quickly that doesn't always work that way.
Right.
Yeah. So, there's a lot of headlines, a lot of fear in the market right now. And I still feel that if done right, being an LP in syndications, private real estate deals should be way better overall than purely having money in the stock market. But with that said, there's a lot of pitfalls, and you cover a lot of that. Let's talk through some of the challenges you've seen over the last couple of years. Perhaps maybe focus a little bit on the multifamily with where I think a majority of the bridge loans are. How bad has it gotten? What have you seen that's posed the biggest challenges?
So I think maybe I have two comments. One, I think the discussion on public market investing versus real estate is a very intricate one, and I guess I'm not sure that I totally agree with what you said. I think it's just an intricate discussion. There are certainly times when private real estate is better. I think it's a stretch to say that it's always better. Um, and there's like factors like liquidity, for example, that just make them different, right? And it depends on what each person needs. It depends on what their net worth is in a sense, and how much money they can have at risk while not having it liquid. Um, that's a whole discussion that we can have. But in terms of, yeah, go ahead. Do you want to have it?
Oh yeah. And I certainly,
Yeah.
I certainly agree with you there. I think, what I've seen is I think a lot of people that have, say, that 5 to 20 million net worth, I think are perhaps underallocated into private equity deals. Those that have almost 100% of their money just in the traditional index funds, Vanguard.
Yeah.
I think they might be leaving a little money on the table, both from a tax efficiency and just opportunity to potentially generate some alpha.
So yeah, I think I would directionally I would probably agree. I've always said, and it's not such a popular comment, but it's my opinion. I think if you sort of look back at the past 5 years, there have been LPs that got involved. I would say actually many LPs that got involved that I think should never have been involved. And I don't mean that as they invested in something bad. I just don't think they should have invested, period. Like, they're not in a state where it makes financial sense for them to invest into private real estate. And like the time that it takes to vet these and all that stuff. Return on hassle, if you will. I sort of like to use that as a measure. Having said that, the opposite side of the spectrum is that there are a lot of very wealthy people who are underallocated to real estate. I think, and I would agree with you on that. I think where things have become a little bit challenging is, I see all the time GPs, I guess, marketing the fact that the stock market is volatile and you should, go into real estate and that's safe. And I just think those discussions are very complicated, and generally like the statements made by GPs around those are like kind of misleading, in my opinion.
Yeah, and that's I actually am on both sides of this, because we do run a fund, we're an allocator, but we're typically trying to negotiate better deal terms and sort of collectively bargain to kind of invest along with my own money with LPs investing with me. So I'm on both sides of it as both someone who has to market and is telling the story, but also is negotiating with GPs to potentially or being a co-GP. So yeah, I see it from both sides, and I'm curious what type of investor is not a fit, because that's I don't know that I've ever thought of it in that regard. So when you talk about people who shouldn't have invested, what are the types of people you think
like
are not
who am I talking about? Yeah. Let's just do like a rough calculation, right? And again, this is just my opinion. Like, and I think many GPs, probably don't like it. I'm open to being wrong. I think, I don't know. I just sort of like speak my mind, and I hope it helps people. And again, I'm happy to debate it. So at a high level, I think the concept that you sort of like pick up your first deck and you're like, oh my gosh, this is the best thing ever, I'm going to invest in it, is like probably not healthy. Like, I can tell you, when I was at a public REIT, my team probably looked at roughly 20 deals, or at least 10 deals for every one that we actually bought. That's after like a pretty extensive screening process before it got to my team, right? And before it got to investment committee, which is where I sat. Like, so I think a very similar process, in a sense, applies to an LP. In other words, just for the sake of simplicity, let's assume you look at 10 different deals and you end up investing in one, right? So how long does it take you to vet every single one of those 10 deals, right? And like, what hourly rate do you put on your time, right? And then let's say you're like, okay, I'm going to do that over 10 deals. I invested in one, I'll put in 25 grand, right? I'll put in 25 grand, and in 5 years you get 50 grand back. Okay. And then my question back is, first of all, this assumes that you actually took extra money, everything worked out. There are outcomes that are not like that, right? But let's say that it was a favorable outcome and you made 25 grand. So then the question is, was the 25 grand worth it? Right? In other words, you spent, I don't know, probably somewhere between 10 to 20 hours, right? Digging into these deals, right? Times 10, right? And then maybe there was legal, one of those that you actually invested in, there's probably legal docs. You have to understand them. You have to go back and forth with question answers, right? All this stuff. And then you sort of take the 25 grand and divide by the time that you just spent. And it's like, I don't know, I probably could have done better just by focusing on my job.
Yeah, that makes sense. And it reminds me, I mean, I have a little bit of money in a venture capital fund. And for me, A, I didn't have the access, but B, I didn't have enough money to have the diversification to pick and choose angel investments or VC investments. So I wanted some allocation in venture capital. I decided to throw money into a fund because unless I was going to be able to make 50 allocations into 50 different deals and have the time and the knowledge and the deal flow, I didn't think it makes sense to invest in any individual venture deal when, frankly, I think in venture, you make your money on 10 to 20% of the deals make you 80% of the return, and more than half may fail. So, that makes a lot of sense on that. Return on time and return on capital, and I've actually over the last year or two that there's been some challenges. I've kind of rethought how I've informally. And I'm not a formal advisor on tax or legal or anything, but I tend to do a lot of informal, similar to you. And I have some more reservations about someone's first investment, perhaps being into one deal as opposed to potentially a fund, just because anything can happen. Even we've seen good sponsors with good 10-year track records have deals that failed over the last couple of years because they got too aggressive with bridge financing. We've also seen markets deteriorate. We're in a deal in Atlanta that just, for 2 years, they weren't enforcing the eviction laws. So, yep. Things can go sideways on deals that are really just out of the sponsor's control. And there's a lot of risk to not having diversification. So I definitely, agree with your point there.
Yeah, that's an interesting topic too. Like, I get your sentiment. I think it's also like I've seen many funds fail. There are many funds currently that are struggling. Particularly on like a sub-institutional scale. And I think although I agree with your comment, which is all else equal, a fund is better than a single asset investment because it gives you transparency. Diversification, right? But that's not all else equal in reality, right? Because typically when you invest in a fund, you have less transparency. You sort of give like a mandate over to a GP and you don't have the ability to see what you're investing in, right? And so that's where like things become a little bit more difficult to compare, right? Because you sort of have to understand how the different parameters of each investment impact the GP's ability to execute on the vision, the alignment of interest between the LP and the GP, and obviously the underlying investments themselves. I mean, you could also argue the opposite, which is, but by a single asset investment, if you're willing to do the diligence, at least you really understood what you got into. Whereas a fund, you sort of invest blind. Not all funds work like this, but like many do. You invest blindly into basically a pool, and then you're kind of like sitting there praying that the GP invested into the right stuff. But you don't have visibility into each asset that they go into until you basically get the check at the end, and hopefully it's good, right? So my point is, neither is really better than the other. They're just like, they're just options, and you sort of have to compare them next to each other and understand the pros and cons and understand which one is better for you.
Absolutely. Let's today was this will be out in a few weeks, but today was a CPI print. We're 2 weeks away from the Fed likely lowering interest rates. What's your overall level of optimism or pessimism for the current state of deals, like the deals you're seeing right now? in the market?
I think things are picking up. Like I'm starting to see more GPs transacting. I think it's a little bit of a double-edged sword. On the one, in some sense, we should be here sort of like excited about the fact that rates should probably drop from here. On the other hand, typically when rates drop, it's because of economic challenges, right? And so you sort of have to wonder if that's what's coming, right? Like some pressures on the economic side, which could certainly lead to challenges on the P&L if you're looking at like a multifamily property, let's say. So it's mixed, like I'm seeing deal volume pick up from there. Look, just from an analysis perspective, and I always say this all the time, like it's very difficult to make any sort of investment without a sensitivity table. A GP, in my opinion, should have opinions on what's coming next macroeconomically at a high level, but they should always present a sensitivity table to explain to the LP, like, look, I think 5 years from now, or somewhere in between today and 5 years from now, we'll be able to refi at a 50 basis point discount to where interest rates are today. Like that doesn't sound like a crazy argument to me. But at the same time, if that does not happen, because I can't control it as a GP, that's a macroeconomic catalyst, right? Here's what will happen to your investment, right? And if cap rates don't move down, they instead move up. Here's what happens to your investment. And it's upon the LP to ask for that information. And as funny as it sounds, like actually understand it. It's pretty important too.
Yeah, absolutely. And we've seen, one of the things I've seen is we had a lot of those sensitivity analyses 2-3 years ago when we were starting, but getting a new update is sometimes harder once you're in the deal. And we've been, pushing for that on some of the deals we're in now, where, we've grown net operating income significantly, but, it hasn't outpaced a 500 basis point move in rates, even with a rate cap. So, trying to, budget 2-3 years out now, and along with other headwinds too. I'm curious what you're seeing on sort of all the new supply. For example, in Dallas, we're at about 90% occupancy on one of our deals, but the rent growth is not quite there. And I had thought that Class B and B minus might have been immune to the Class A supply, but at least on some of our deals, we are seeing pressure where it's trickling down, and they're kind of the top end renters are going to the old Class A, which is now a B plus, because someone else got 3 months free rent at a new place. So I'm just curious if you're seeing that across yourself and some of your group's portfolios.
There's like pretty serious supply pressures in many markets, especially sort of like the hot ones, such as Arizona, Texas. I've seen stuff in Florida, certainly other places as well. Look, Jack, it's tough. I get decks sometimes where the rents were pulled from comps a month ago or whatever, and the comps have decreased their rents in the past few weeks significantly to something lower than what they were a month ago, right? And so many places have year over year rents go down. Another thing to look out for is whether the rents are real rents. In other words, were there sort of like any sort of incentives put in place? Sometimes that's gift cards. Sometimes you get a free month rent. If it's a gift card, sometimes it's not recognized on the P&L, but it can be like a very significant netting against your gross rent, right? And when you start looking at stuff in detail, you start to find like, maybe market rates are dropping year over year, and I shouldn't assume 3% rate increases every year. And by the way, remember, obviously you know this, but it's like the 3% increases are based off of a market rent set today. And the real question many times in these deals is, what is the market rent today? Right? And that's what, like, as an LP, you have to spend a lot of time understanding that.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.